Are you ready?
Ready.
All right, let's go. Kevin here, Top 1 Financial Advisor and best-selling author. We are here to talk about the stock market. All right, it's 2023 and we need to discuss what we should expect this year. Now, I'll come out and said for a while now that nobody has a crystal ball, and there's definitely going to be something we do not expect to happen that throws off our expectations. It could be a good thing, could be a bad thing. I have no idea, because we saw this in 2022. We knew about inflation, we did not know about the threat of recession, and we definitely didn't know about Russia and Ukraine. So today, I've got about 5 charts that I pulled from the Washington Post that should give us some context, and it should definitely inform your portfolio as we move forward. You want to use this information and start to align a portion of your portfolio to match up with this. I'll talk about how to do that as well. So as I go through this, I'll be reading some of these charts from my phone, and I'll make sure that the charts are also on the screen. So the first one is inflation. That was the word of the day, or the word of the year rather, in 2022, and it was one of the reasons why people were talking about inflation I-bonds. We started talking a lot about inflation protected bonds and things that protect you against inflation. Now, inflation is slowing down. Now, that was a whole point of raising interest rates, and it does work. It has worked. It has almost always worked throughout history, and it is a painful process, as you can see, by rising interest rates, whether it's your credit card, we'll talk about that later, or mortgage rates and all those types of things. But you can see here, the last reported number we had was 7.1. This is an increase, or an improvement rather, from where it was earlier last year, where it was as high as about 9%. Now, according to who you ask, whether it's the Federal Reserve or Morgan Stanley, as if that's a person, it's really a bank, but it is a person, or JP Morgan, which is also a person, and it was a bank too, but in either case, you can ask them, and they say that inflation is going to get down to 2.4%, or anywhere around between 2 and 3% by the end of this year. I don't know if I can vouch for that, but I can tell you with confidence, at least in my view, that yeah, inflation is going to come down, but rates are going to go up. That is going to hurt any stock, in my view, that is borrowing a whole lot of money. That is going to be a problem for those stocks. I've already talked about how you can look at a balance sheet and see if a company is borrowing a lot of money. We talked a lot about Mullen Automotive that had $74 million in debt and only $17 million in cash. That's a problem. And it's not just them. There are several companies out there. So anything that you do invest in, see if they have a positive cash flow. Do they have profits? Or do they have losses? And are those losses piling up, or are they shrinking? That is going to be one of the things that you must look at in 2023, and something you should have been looking at really most of last year, and is why we talked about it so much. All right, the next one here is borrowing costs. This is an impact to rising interest rates. Now, according to some, I've already said this plenty of times, I think they're going to raise interest rates for all of 2023, but that could change. From what I read from Barclays and Morgan Stanley again, they think it's going to be, they're going to raise rates all the way through about June, and then they're either going to stop or cut rates. We'll see. It's obviously very early to tell. But borrowing costs, we've seen here that you can see how credit card rates have kind of been steady and then are up to about 19%. That's obviously going to increase. We'd expect all of these to increase, but you can see here from 2020 to 2022 how the market has actually shifted, because as the Fed cut rates, that is when the stock market exploded in 2020 and 2021. I think in 2021, the stock market was up like 27% in a single year. And then they start raising rates and the stock market drops 19% the next year. So it is a correlation. That is because, one, as investors, we want companies to grow. And when companies that don't necessarily have profits want to grow too, they borrow money, invest it, hire more people, sometimes too many people, and try to just grow aggressively as they possibly can. And when those things reverse, that's when they start to tank, and that's what we saw in 2021. So we will continue to see borrowing costs go up. It also slows down people. As you can see here with the average mortgage rate and the 60-month car loan for new cars, 6.1%, yeah, it's going to creep up. It's going to slow people down and say, hey, look, I'll wait for that car, right? I might not want to get that car right now, which is one reason AutoZone and O'Reilly's have done well because people are slowing down and holding their cars for much longer. And I would expect that to continue as long as these trends continue in terms of rising interest rates. So that's something that you want to pay attention to. Anytime that rates rise, what are the places that can help you? Now, banking is supposed to be that. However, if we go into a recession, it's not going to help the banks. It's one reason why I'm continuously holding O'Reilly's. I would expect AutoZone and General Parts Company, GPC, to continue to do well because of this rate issue. So that's number 2 that you want to just have in your pocket. Now, the next one here is manufacturing. This is U.S. Manufacturing Index, and it is shrinking. This is known as a leading indicator because the more stuff that we make and manufacture, that means the economy is growing. If that starts to slow down, that means the economy is shrinking. If the economy is shrinking, that's going to put you into a recession if you do it long enough, which is 2 consecutive quarters. Also, if we are making less stuff, we need less people, which means unemployment rises. This is an indicator or leading indicator of whether or not the economy is healthy and whether or not we're going to go into a recession. As you can see, it is starting to trend downward. Okay, it's starting to trend downward. That is going to be at least an issue. It's going to be an obvious issue if it continues to go down this route. So it's something that you just want to watch and just be aware of. Should we go into a recession, you're still going to want to hold certain stocks. I think healthcare still going to be a spot, right? I think a lot of the auto companies that I mentioned, O'Reilly's, General Parts Auto, AutoZone, still going to be quite important because in recessions, people start to hold on to those. And obviously a lot of dividend companies are going to be key because people, when there is a recession, people say, hey, look, let me just go for dividend stocks so at least I can get somewhat of predictable income. Other companies too could include a General Mills, could include SJM, Smuckers, because you're still going to eat. You can throw Coca-Cola in this category too. So those are some places that are usually safest in a recession if that's where we go. Okay, so keep those in mind. Next here is the job market. And this is one I've talked a little bit about before in this video actually. So we said that unemployment 3.7%, near a 50-year low. But the Federal Reserve does expect this to creep up just a bit. That's because they're increasing interest rates, making it more expensive for businesses to borrow, which could have them to either slow down or shed its hiring process or shed its current staff. That is going to be an issue, obviously, and not something that anybody wants to see. The expectation is that unemployment rather, is going to creep up to 5%. Not going to be great. Right now, as the time that we're recording this, we know that inflation is at, there's 1.7 jobs for every 1 unemployed person. So people have options. However, it was 2 earlier in 2022. So you went from 2 jobs for every 1 person down to 1.7. They expect that to reverse and not be so great for people looking for jobs in 2023. If that is the case, yes, inflation will come down, but the job market is going to be shaken up, and that is going to hurt the economy a bit, which can kind of get things back to where they quote unquote should be in terms of prices not being as unpredictable and as high as they are. If unemployment starts to creep up, you're going to hear a whole lot of that recession word, and that's going to be an issue for certain companies. So you want to pay attention there. All right, the next one that we want to talk about is personal savings rate. Now, this is something that I've also discussed a lot, I would say, between September and December of 2022. The personal savings rate is how much are we saving as a country, right? How much money do we have in reserves in case something happens? The other part of this is the more that we have, and I hate that this is a thing, but the more money that we have, that we save, which is what we should be doing, that means that we have more in our war chest, if you will, to go outbid, right? When it was COVID, and you can see that huge spike in this chart here, people were saving above 30% because we weren't traveling. We weren't really buying gas that much. We weren't traveling anywhere anyway. It was like, hey, wasn't paying student loans, wasn't paying daycare. We were all stuck in the house. So we had so much money to just sit here. So people were outbidding, paying $1,000 for a $500 PS5. That did happen. Not for me, I didn't do that, but it did happen. And that is something that we do want to watch. Well, as you see, that personal savings rate has continued to dip, which means that if you have a low personal savings rate as a country on average, low personal savings rate, and unemployment goes up, that's going to be an issue because people who could be unemployed won't have the savings to protect themselves should that occur. The other thing too is as people start to spend down that savings, that's also going to stop inflation or at least slow it down, because we're not going to have an extra $200, $300, $400 to spend on whatever goods and services that are out there. So that is good. That's going to bring down inflation, but you don't want to have someone be unemployed and not have savings and have that gap, because that can be a very traumatic process from a financial and personal perspective. But it is something that you absolutely want to watch, and something we've talked about before. I said, because we had a record, whatever $1 trillion it was, we did a whole video on it. That was one reason to say, look, do I want to pay an extra $200 to fly home to go on this vacation? No, but I got it because I've been saving for a whole year and I haven't had to make student loan payments or whatever it was. People had the money. That is not going to be the case, and it hasn't been the case for a while as that spending has dwindled down. So for me, is it going to be a recession? Is it going to be very ugly in 2023? I don't know, but I will say it wouldn't shock me. I will say that it wouldn't shock me. The problem here is that just because you go into recession doesn't actually mean that the stock market is going to fall. There have been times where the economy has been in recession and the stock market be fine. We saw this in 2020, where at one point the market was down and then bounced up. At the end of 2020, the market was up like 15%. Even though the economy hadn't fully recovered at that point in time, there was still some problems, but the market was up. So there's that. If you look at a lot of the major banks, Morgan Stanley, Bank of America, Barclays, all of these others, half of them say it's going to be a recession, half of them don't. For me, I kind of think that, I'd hate to be negative, I kind of think that you have to have a recession just based on, not that we want to have one, but I think we have to have one because with rates going up and unemployment having to go up, because you will never have an unemployment rate of 0, because some people just don't feel like working, and that's fine, right? Or you're taking your time, you're doing your own entrepreneurship thing. That actually counts inside the entrepreneurship, the unemployment rate, but that's how they calculate that, video for another day. But as they start to raise interest rates, by default, some companies are going to stop hiring or at least start to slow that down. That personal savings rate has been dropping. It's going to get back to where it was, which is not a good spot, and that's going to definitely slow down inflation as well. So I do think inflation is going to come down. I do think unemployment rate is going to go up, and if it does, it's going to bring down manufacturing, and that could definitely put us into a recession. But I don't think it's going to be the worst recession that we've ever had. I don't think we're going to 2008. I don't think we're even going to the worst part of COVID either, where unemployment soared. 5% sounds okay. I know it's not great to say that, but I think 4 to 4.5% would be my best prediction if I'm going to put one out there. So those are my thoughts. If all of those things are true, what should you be investing in? The same things that we was investing in 2020 until that situation changes. I'm sticking with what I got. Healthcare, dividend stocks, energy. When I say energy, I'm more so thinking about like utilities, so power plants, companies like that. I think those are going to be probably the best bets until we get more information. Because right now, there's nothing that has changed the trajectory of the stock market at all to this point. So those are my thoughts. Let me know what you think in the comments below. If you want to learn more about the stock market, you know where to go inside the Members Only, where we do videos every single week. And we go into deep dive details about everything you need to know about the stock market. All right, that's it for me. Talk to you later.